I remember my broker telling me, what are you doing buying there? That's a shithole. You're not going to get anything there. You're going to have to close your windows before you drive through that suburb. And I've heard that with a number of properties I've bought from him. But that's kind of a litmus test for how the majority of people choose property is, would I want to live there? And obviously the results are there on the table now that it has performed well.
Welcome back to Dashdot Insider, the auditory epicenter for passionate property investors seeking a life of freedom, choice, and abundance. Joining me today is another perennial guest, Nic Denshire. Nic, how are you today?
I'm going great, guest. I'm really happy to be here.
I'm excited to have you back on. You've obviously been on the podcast a number of times over the years. You're the second longest serving member of the Dashdot team, aside from myself and Gabby, which is pretty awesome. And you've been through not only a pretty awesome property journey for yourself, but you've helped hundreds of other property investors successfully grow and scale their property portfolio. So you've got a really unique perspective on the market. And one of the things that I've always liked about you, Nic, and I think that you bring a lot of value to the team, is your ability to challenge your own assumptions and also challenge existing assumptions about things, and at least be prepared to challenge the status quo, or even to challenge if the status quo is being challenged, and why. So you tend to have the ability to take ideas and seek to pressure test them in their validity, which is why I'm interested in having this conversation today about buy and hold versus buy and sell, or in other words, a trading type strategy when it comes to property. So to set this up, I'd love to ask you, how do you think about this? And for the listener, what I'm talking about is most property investors have this belief or this understanding that the best thing you can ever do in real estate is to buy and never sell, buy and hold forever. And if you do that, that's where you're going to make the most amount of gains. And to a certain degree, that is true over a long enough time horizon. And the status quo has always been that you shouldn't buy and sell because things like, selling costs will corrode all of your profits. Heuristically true, but is it absolutely true? And Nic, I'd love to know your evolution of thought on this specific topic. Where did you start and how do you think about it now?
Yes, I definitely started as a buy and hold, and I was very much yield focused. I've still got a bit of a yield bent, but I've certainly tempered with that after seeing how important growth can be and how much you can outperform with growth as opposed to trying to focus on yield all the time. And most recently, after looking at hundreds of properties and hundreds of median sales price growth signatures in different regional areas, and as you know, the majority of what we buy now is largely in regional areas or with regional type signatures, the majority of the growth cycles in those have a significant growth period over 3 to 5 years, but maybe let's say 7 years to be conservative. That'd probably cover 90% of the growth cycles in the regional areas.
Right, on average, it's 5, right?
And a doubling to tripling is typical in property value, which seems bonkers when you're buying a house now and you're like, I'm buying at 500 and tell me it's going to be worth $1.5 million in 3 to 5 years. But the data doesn't lie, and the data shows that in those past growth cycles, people bought at 50 and it went to 150 in 5 years, or they bought it at 200 and now it's worth 600. So it happens, and it's real information. And it's repetitive enough to kind of, without me analysing the statistical significance of how often it occurs like that, but just anecdotally looking at those signatures all the time, what's typical is they grow for that 3 to 5 years and then they do nothing for about 10 years. And I think the kind of broad understanding of the buy and hold thing is that you're buying and holding because of those exit costs, but also because most people, when they're buying, don't have access to that data and be able to pick those cycles. And so the longer you hold, the longer you're likely to experience a capital growth cycle if you're just buying at random. So if you haven't had any growth, you're probably even closer to the growth cycle. So you're better off to keep holding than try and roll the dice again and throw the data to another place and hopefully get the right point in time at that point. So what the difference is with the access to data that we have and with the access to data that we give to our clients is that we can take out that huge risk factor. We can be quite certain we're not going to land at the start of the 10 years of no growth and have 10 years of no growth. We're quite certain that within 12 months, we're going to have a significant amount of growth. And if you can bank on that, and if you can repeatedly do that, then my assumption's being challenged. And I think you're better off to ride that growth cycle. And then rather than sit there for the next 10 years and have nothing or little happen, which is quite characteristic in these regional markets, better off to sell and redeploy that capital into another growth market. That's where I'm kind of at the moment.
Yeah, it's super interesting, right? Because what you've pointed out is really, really true. So most markets operate with an S-curve dynamic. So what that means typically is they'll go through a flat period and then they'll go through a ramp-up curve, so like the bottom of the S, and then it'll grow precipitously and then it'll start to taper off at the top. And so you end up with this kind of like median sales price graph, which kind of looks like an S, right? That's the nature of it. And actually S curves as a market dynamic signature, to use your term, appear in all kinds of markets, particularly where, there is a matching market consideration, which is specifically what actually operates within the real estate market sector. It's kind of supply and demand, but it's also not really. There's a matching market principle, which to that degree, real estate markets are much more like dating markets, or the real estate market's more like Tinder than it is say oil, which is a commodity, which is super interesting because the specific way that the market dynamics move are uniquely different to other commodity-based pure supply and demand kind of relative markets. Now, what's really interesting about that is this heuristic that people have that property doubles every 7 to 10 years, right? Or property doubles every 10 years is kind of the more kind of common framework. Now, if you take a 10-year slice of a market, you may very well find that from the start of that 10-year period to the end of that 10-year period, the prices have doubled. But if you look a little closer, you might find that doubling happened between year 3 and year 7, for example. And between year 1 and 3, it was flat. And between year 7 and 10, it was flat. So then you've got to ask yourself, and then also just to kind of book in on that, that'll be the start of another S-curve potentially, where you might have years 7 to 10, it's flat, and then years 10 to 13 are flat. So then you have sort of 6 years, and I'm using just generalizations here because it could be 6, it could be 10, it could be whatever. You have to go for a protracted period of either low growth, no growth, or even potentially declining growth before you end up having another growth spurt again. And so then the question you get to ask yourself is the measurement window incorrect? Now, this belief has served people well in a time when they never had access to information in the way that we have access to information these days. And necessarily, as your capabilities change, so should your thinking. Now, once upon a time, it just wasn't possible to even know, there was a belief that it's impossible to time the market. It is impossible to time the market. Now, I remember when you started working with us, Nic, and you and I had this, you were very much focused on, the word you used was intensifying property, because you believe the only way to really definitively make sure you were going to get some juice out of the asset was to buy something you could add value to. Now, that, again, is a belief that stems from the same place as this property doubles every 10 years. Okay, so fundamentally, no one knows what's going on with property. So therefore, you can't ever time the market. And therefore, the only way you can make sure that you're going to get the growth is to buy something and add value, which if that is your strategy, then literally it doesn't matter where you buy. You could buy anywhere in the country. It just doesn't matter. You don't need location does not matter. Just find something and add value to it. But then also going back to the market kind of type, the doubling every 10 years and whether you should buy and hold. It's like, if you didn't know about the S-curve dynamic in the market, and if also you weren't able to identify where else you could potentially position your capital, then the safest thing you could do is to stay in the market long term. Because let's say over a 10-year period, the property values double over 5 of those 10 years. So 5 of them, the market is flat, and 5 of them, the price doubles, right? So you have this kind of S-curve in that. If you have no idea about market timing, then the best thing you could do is hold it for not just 10 years, but 20 years and 30 years. And over that period of time, you'll go through potentially 3 doublings and off you go. However, if you had the opportunity to take it from the bottom of a market cycle to the top of a market cycle, then take the capital out of that market, reposition it in another market at the bottom, take that to the top, how much faster would you grow your capital? And I think this is the consideration that most people need to have, because we're in a changing environment. We're in an information age where things are different. What are your thoughts on all of that?
Yeah, no, I have many of these conversations with clients, and one of the things that helps explain the situation around that compounding return is what's called the rule of 72, which you've probably heard of, and I'll explain it briefly. And it's basically that the time and years that it takes for a property or something to double times the compounding growth rate equals 72. So if I take 72 and and it takes 5 years to double, if I go 72 divided by 5, that would mean it's got a 14.4% compounding annual growth rate. So if we look at that on a 10-year time frame, if the kind of urban legend is that property doubles every 10 years, we're talking about 7.2% per annum compounding gives you a doubling every 10 years. And that's roughly in line with the average for Australia, which is somewhere between, 6 and 7, depending on who you ask.
Between 6 and 8. Yeah.
Yeah. So that kind of makes sense that's, that has some basis that property doubles every 10 years. But like, as you say, in practice, as I observe in the median sales price graphs, what's typical, particularly in regional markets, not so much in capital city markets, is that the bulk of the growth happens over, let's say, a 5-year period, which equates to 14% growth over that 5 years, and then you get nothing for the next 5 or maybe even 10 years. So, so why would you sit in there for that remaining 10 years if you can pull that capital and redeploy it? And I've had this exact situation in my own portfolio where I'm selling a property that the first property that I bought was Dashdot. Might have talked about it before, I'm not quite sure, but it was out in Ipswich area in Flinders View. And that was one of the ones that helped me get away from the whole intensification debate. And what the short Cliff Note version of it was that we were able to buy a property, pre-existing property, that achieved the same yield at purchase that I would typically have achieved after my intensification efforts. So I was getting 6% or 6.2 or something percent gross yield at purchase. Plus it was at the start of the capital growth cycle. So 3 years later, I've had about 30% growth compounding per annum on that property for 3 years.
Compounding per annum.
Sorry, no, that's not right. 30% on return on investment compounding per annum. And the actual property value has grown at 16.8% per annum.
So the property value has grown at 16.8% per annum for 3 years.
That's right.
Which is epic, right? Because the national average growth rate is like, we'll call it 7%, just to be simple, right? So you've over doubled the growth rate, national average growth rate, for 3 years in a row. So I can't quickly do the maths on that to work out what the 3 year compound is. What was the price and what's the end value at 3 years?
So I bought it at 435, and I had it on the contract. It's actually on the market again, but because the contract fell over, but it was under contract at 718. So let's say it's worth, say, 700 now.
Yeah, okay.
So what my calculations are is that the return on invested capital on a compounding annual basis is 30.2%. So on how much did I put in? 122 is what I put in, 80% LVR. And the actual return on the value of the property is 16.8% per annum.
So let's talk about the return on invested capital, because I think this is actually because at the end of the day, this is the actual number that matters. Everyone focuses on things like property growth, right? But what we're actually talking about here is the usage or the deployment of capital in the most efficient and effective way. And so when we're talking about buying and selling, or having a sort of trading-based strategy where you buy into a market and sell out of a market and reposition your capital, the thing that you're going to get is not going to be the property value. The thing that you're going to get is the return on your invested capital. So if you put in $100,000 and then you sell a property 3 or 4 years later, how much money do you have to then redeploy? And so is it okay if we just kind of dig into that a little bit? Because I think this is actually really going to illustrate the point. So the original capital that you put into the property. Now, for the purposes of everybody's understanding, when we talk about capital at Dashdot, we talk about the deposit, the stamp duty, the building a pest, like all of the money you have to put into the deal, right? Because that's all your capital. So it's not just the deposit, it's how much money did I have to put in towards this deal, including any fees that may be associated with Dashdot and so on and so forth. How much money went into the deal? In this case, it was $122,000 you put into the deal. Now, on an assumed sale price of $700,000 to $718,000, because you just said the contract just fell over, what will be your realized capital at the end of that, if you have that number or anything approaching it?
The total left after entry and exit costs and tax. So I don't know what the fancy term is for that, but that's the total cash that I end up with in my hand after tax was $285,742.
285.
Yep.
Okay, so that is 122,000 to 280. Let me just quickly do the maths on that. I'm always slow at doing percentage calculations, actually. So 122 to 285 is 133%, 133.6%, we'll just call it 133%, return on your capital.
Yep, in 3 years. Is that what it was?
In 3 years.
Yeah. So if we go back to that rule of 72, so I worked out the compounding growth rate on the invested capital is 30.2%. So that would mean 70 divided by 30.2 is 2.4. So at a growth rate of that invested capital growing at 30% per year means it doubles every 2.4 years. And I had a bit longer than 2.4 years, 3 odd years. So I got on more than a doubling in that capital. 3.2 years it was, yeah.
So that doubles every 2.4 years. That's crazy. Yeah. And so because you held it for a bit longer, that's why you had 133% growth as opposed to 100% growth.
That's right, yeah. And what's crazy isn't that it happened, because you hear lots of stories of outliers where people had these things happen. But what is incredible is that this isn't an outlier. Like, we see it time and time again, and it's hard to help people believe that. Hopefully I share my story with lots of people just to make it real, and that it's a real story. But we see that every day with our clients. It's not an outlier, and that's why in this case I've got this property on the market, because the data analysis is telling me that we're probably at the peak or close to, from a number of different sources. And it's time to get out and hopefully repeat that same pattern again, rather than sit there for another 5 to 10 years with nothing happening.
Yeah, and what's really interesting about that too, right, is even the fact that so you've been in that. So we got into that. I helped you buy that property personally, so that was obviously a while ago now. And that was at the bottom, right? So we sort of got in right at the sweet spot. We found there, that real nice moment where we were at the bottom of the S-curve. 3 years later, you have identified, hey, now's the time to get out. But it's not always 3 years. In some markets, it could be 5 years, right? Which is really, really interesting. And so these kind of generalized rules of thumbs and these kind of assumptive basis for investment that people have tends to steer people wrong. You were chuckling a little bit there. Do you want to expand on that?
I was just thinking at the time when I bought there, because you were saying we were just at the sweet spot. I remember my broker telling me, "What are you doing buying there? That's a shithole. You're not going to get anything there. You're going to have to close your windows before you drive through that suburb." And I've heard that with a number of properties I've bought from him. But that's kind of a litmus test for how the majority of people choose property, is would I want to live there? And obviously the results are there on the table now that it has performed well. That I just find it funny that I hear that quite commonly from people, that it's not a great area to buy because I wouldn't live there myself. But yeah, in practice, there's the numbers.
Yeah. So how do you? I'm actually just looking up some numbers here. By the way, so the top hedge funds in the world, for top 20 best performing hedge funds in the world, right? So you got a 33% annualized return, right? Which would put annual growth rate, which would put you in the top. That'd basically put you right about about number 20 or 21 in the top hedge funds in the world, right? In terms of returns, right? Like in terms of annualized returns, which is crazy. I mean, the fact that you were able to get a 133% return on capital in 3 years is outrageous. And I think this is the thing that most people don't understand. Now, here's the kicker to that. If you decided to stay in that market, your returns might not get that much better.
No, they'd go backwards on an annualized basis if you average it over time. Yeah.
On an absolute basis, right? On an absolute basis, they might not. Let's just be generous and say they stay the same. Let's say the property value doesn't change for the next 5 years. So you've got 133% return on invested capital in 3 years. And maybe in 8 years, you've still only got 133% return on invested capital, right? And that's where it gets pretty interesting, because, the thing that makes Warren Buffett so successful isn't in fact that he is an investment genius. The reason he is so good is he is excellent at capital allocation, very specifically capital allocation. And capital allocation is a real skill that most people don't develop. In fact, I consume lots of information about lots of things, but specifically I was doing a deep dive on the world's best CEOs, the best CEOs in the world over time, over the last 50 years, the ones whose companies have drastically outperformed the market. They've also been, the best leaders and all of this kind of stuff And the single trait that tied them all together to get the absolute best performance was that they were the best capital allocators. And this is the skill that we're actually talking about right now. It's the ability to kind of see through in a kind of non-emotional way and go, okay, is the capital that I've got in the market allocated in the best possible way to get me closer towards my goals? Because at the end of the day, everyone broadly has the same goal or outcome to be able to build wealth. Now, I recently defined wealth in I think what is a useful way. Wealth is the freedom to live your life in absolute accordance with your highest values. Now, that is really interesting because it's not about who has the most amount of money. It is creating the freedom to live your life in absolute accordance with your highest values. Now, a portion of that is going to be money and that's going to depend on what your highest values are, because I know people who have very little money and live completely off grid, like out in the bush and all of that kind of stuff, and they are absolutely living in accordance with their highest values, right? And they're loving life. And I would say that they're wealthy as fuck, basically, right? Right? They are like, but for most people, there's going to be a financial component to it. It's like, well, I don't want to necessarily live a subsistence life in the bush. So how do I afford the things that matter most to me, right? And I was actually just discussing this with Gabby earlier, and like frugality, like I'm not wasteful, but frugality is not one of my highest values. Like that's not something I don't take pride in trying to find like how to pay the least amount of money for something. Like frugality is not one of my highest values. And so for me, it's important that I don't have to feel like that has to be. I'm not forced into a position where I need to think about frugality. But that kind of like that nominal figure of capital and financial aspect of wealth is going to change for different people. Nonetheless, everyone effectively has the same goal, which is to create wealth, which is to create the freedom to live their life in absolute accordance with their highest values. And the way that people can achieve that faster is by challenging the status quo of their thinking and actually starting to tease out some of these ideas. I recently had one of our clients reach out to me with this exact same premise. He's got 10, 11 properties now. 9 or 10 of them he's got 11 properties and 10 of them he's bought through Dashdot. He reached out to me. It's funny timing that we're doing this podcast actually, because he reached out to me, I think last week, and he was like, Goose, I've got to ask you a question. I've had this long held belief of just buying and holding forever, but I actually think it's starting to make sense for me to just like sell some of these properties. And I'm like, yes, but here's the thing. It's hard to have that conversation with most people because it's so far from the traditional paradigm that people kind of get freaked out by it. If someone's trying to get over the emotional hurdle of like getting invested in property, you probably don't want to push them too far and say, yeah, you should buy it. And guess what? A few years later, they're going to sell it, because the whole idea of buying is already daunting enough. And now you're already telling me I'm going to sell it before I've even bought it. It can actually be a little unsettling for people. But there's a maturity that comes with the process that I think allows people to make these better decisions. Over to you, Nic.
Yeah, I think that's very true. It's definitely a maturity thing, and there's definitely stepping stones along the way, and there's definitely qualifications around it. So like buy and hold if you don't have the tools at hand to be able to accurately pick the market. That's a sound investment basis. The other one I would say around selling is and clients often come to us with this. They say, oh, I've already got these other 2 properties. Should I sell them? My response to that is, unless they're going downhill, then you're probably better off to deploy capital that you've already got, lazy capital sitting there doing nothing. So money in the bank or savings or even equity, as long as the property's not going backwards, you're better off to deploy that and just let those properties be based on that same premise that they could be, as long as they're not going backwards, they could still give you something in the future. The point where you start to go back and assess whether your capital is working for you is when you've either run out of capital or you've run out of serviceability, one or the two, and you can't get the leverage. Then you go, well, okay, I'm at my limit. Where's my laziest capital? Where's the capital I've got tied up that's doing the least amount of work, that's building my wealth the slowest? And I think that's kind of what's forced my thinking on this, is that I'm kind of I haven't got any borrowing capacity anymore. So I'm like, well, that property's lazy. He's done his work. He's grown for 3 years or whatever. All signs are that we're at or over the peak, and let's redeploy that and see if we can do it again.
Yeah, I think that's a really great point, right? Because the only thing that is absolute is that there are no absolutes, right? And so is buying a property to add value to it through a subdivision or whatever good or bad? Well, depending on where you're at in your portfolio, it could be absolutely the wrong move or it could be the perfect move for you. And so where you actually start to get down to is portfolio composition or portfolio theory, right? Which is something that we lean massively into at Dashdot because I like to call it strategy agnostic. It's like, okay, well, all of these things can work, but how would you know if they're able to work for you specifically based on your set of circumstances? That's the interesting thing. And is it potentially a really good idea to have some properties in your portfolio that you're like, okay, I'm going to buy this and I'm probably going to sell this in a couple of years? And is it also sensible to have some properties where you're like, okay, so this might not be the rocket ship in my portfolio, but this is the kind of property that I'd be prepared to hold for the next 20 or 30 years anyway. I was talking to someone the other day and I said, if I had tons of capital and Dashdot didn't exist, what would I do? And I would pick some like fairly safe locations where I'd be fairly confident that the city or the town or whatever would continue to exist over long term. And I would just put my money in there and I'd wait 30 years. I'd just be like, okay, well, if I didn't have to, because to your point, if you didn't have the tools and the capabilities, I'd be like, okay, I'll just take the slow road and I'll take the safe road and I'll get there. If you do have the capabilities, it actually gives you the ability to be more discerning in your portfolio composition. So modern portfolio theory is based around the idea that the optimal portfolio composition to deliver you the maximum returns has a combination or a mix of some assets which are going to be low risk, low return, some assets which are going to be higher risk, higher return, and a combination of all these kind of things. And through the correct allocation of capital amongst those assets, you will actually find the optimal yield curve in your portfolio. Now, I will give an example, a personal one from my own portfolio. So I bought a property a couple of years ago in Port Augusta. Now, Port Augusta is a tiny little town in South Australia. It's red dust kind of land. It's pretty industrial. Like lots of people. When I told my parents, they were like, "Port Augusta, like what?" Like you haven't thinking, God. Now, I didn't buy that property thinking I'm going to hold it for 20 years. I bought that property because I was like, this place is going to go off like a rocket ship, and I'm going to sell it in like 3-ish years, 3 to 5. As soon as I start to see the market kind of change, but I reckon it'll be within 3 to 5 years tops, right? I was like, I'm going to get in there, I'm going to cream it. Now, I bought that, gee whiz, I don't know, a few years ago now. The last 3 years, it's had that market's had 56.3% growth, right, in that market. Now, do I think that I would want to just like, I'll just ride the market ups and downs in Port Augusta for the next 30 years? No. I bought it cheap. I'm going to sell it for a ton of money. I'm going to have a fantastic return on invested capital. Then I'll go redeploy that capital elsewhere. I have other assets in my portfolio where I'm like, I'm pretty sure this is going to be pretty good for the long term and I might want to keep that assets there. And I think it's okay to have a mix, because getting dogmatic in an approach and saying, well, you must only do a trading strategy or you must only do a buy and hold strategy, I think is going to be the wrong way to think about getting the best out of your portfolio and subsequently your life.
Yeah, I agree with that. I think it kind of goes to a broader way to live your life, but and also it's an example. When I first came in the door at Dashdot, there was lots of quite like binary rules. Like when I came through the door, you said anything above 20% public housing, we're not going to buy there. Anything that's on a main road, we're not going to buy there. Anything below this yield threshold, we're not going to buy there. That sort of thing. And I see clients come through with that same idea. Back to your original point about if you didn't have the tools that we have at hand, where would you buy? And I'd probably buy, within certainly 50 k's of a capital city and ideally a bit closer. And that's what a lot of clients also come through the door with. They want to be within 50 k's of a capital city. And if you didn't have the tools, that's probably what you do. But to come back to the point I was making, you learn those rules first, and then you learn how to break them as you get more data. So a hard threshold of 20% public housing isn't such a hard threshold once you start to analyze the data. And recently, the team's been digging into that, and we found particularly in the lower price markets that those ones actually, the lower value houses in lower price markets outperform the higher value houses in the lower price market. So you're better to buy at the bottom end in the low market, and conversely a higher end of the market in a higher value market. So the point being that those rules serve you until they don't, until you've got enough information to challenge them, I guess. And I think the kind of a test of where you're at is when you can say to a question, well, that depends, as opposed to having a binary answer on it. So is public housing bad? Well, that depends, or that sort of thing. It kind of, there's a lot of nuance to it as you dig in further, as you gain more knowledge.
Yeah, I agree. The way that I think about it is rules exist as safety nets for inadequate capabilities. And that's what it is.
Right. Or information, yeah.
Yeah, exactly. Well, capabilities include, coming from information. So the way to think about that is like, is jumping in the ocean safe or unsafe? Well, it depends. If you're a 2-year-old kid who doesn't know how to swim, you better have a safety net, which is floaties or something like that, to make sure you don't drown. If you're an Olympic swimmer, then fucking go skinny dipping. Who cares? Like, whatever, just get in there. And to that degree, like, yeah, early on, like, we had rules that existed because we didn't have adequate enough information or understanding or capabilities to know definitively how far we could move in a specific direction without overexposing the risk profile of the return. Because what you got to really think about is risk-adjusted return, right? And that's really what you're trying to consider. Now, risk is a factor of understanding, right? Because the more that you can, what's the risk of me doing brain surgery on you today, Nick? Pretty fucking high, because I've got no idea what I'm doing. Like, I'll chop it up, like it'll end up like mashed potato in there. I don't know what I'm doing. But what is the risk of the world's best brain surgeon doing brain surgery on you today? Pretty low, because they're an expert, right? And so risk is only a factor of knowledge, capability, understanding, and all of these other kind of things. And so what you actually want to be trying to optimize for is what is the best risk-adjusted return that you can get in any set of circumstances. And so, yeah, to your point on the public housing thing, it's like, okay, cool. So until we know better, we need to assume, or we developed a thesis where we can confidently say, this is good. And until we can develop the capabilities, understanding, information, knowledge, insights to challenge that, then you've got to kind of have a point to stand on. I remember specifically, we had a rule, no pools, right? No pools. We never buy properties with a pool because we didn't understand how to, we didn't have the capabilities at that point in time to understand and manage risk. Now, then I remember Tim from our team, he said, hey, you know how we've got this rule, no pools? I said, yep. He said, well, I've got this property and it's got a pool and it's got a rent, and the cost of maintenance on the pool is whatever it was. And, but it's going to, because it's got a pool, it's going to, like, the rent is going to end up being 3 times, like the difference in the rent is going to be 3 times more than the cost of the maintenance on the pool and all of this other kind of stuff. And so does that make sense? I'm like, well, that does make sense, right? And so your ability to be nimble in the thinking is also going to give you a strategic and competitive advantage. And back to your point around the like, most people think I need to buy within 50 Ks of a capital city. Because again, I agree. I actually agree. Like, if you have no idea what you're doing, like if you have no tools, if you have no insights, if you have no capabilities, and you've got some capital and you're looking for the best way to manage that risk whilst hoping to still get a return, yep, I would probably agree. It's like, if you really don't, there's 15,264 towns and suburbs in Australia, but there's 7 capital cities, right? And so if you had to try and hedge your bets a little bit, you could probably pick a capital city because there's less of them. So there's inherently less risk that you're going to get it wrong, and position your capital close to that and go, probably going to be okay over the long term. And you'll probably be right. But that doesn't mean that it's actually the best way to do things either. And I think challenging assumptions is critical if you want to achieve wealth and freedom, happiness and success.
Yeah, definitely. And that's something I'm reminded of every day. And I talked on a previous session about my ego getting in the way in terms of thinking I can do better than Dashdot. And I've reflected now, and I've reflected on a lot of my clients' journeys, because I started the journey with a lot of other clients, similar levels, similar pay and all that sort of stuff. And I've watched some of them outperform me based on following the advice that I've given them, which I haven't followed myself. And it's quite kind of, I guess, sobering, or what's the word, helps you to reflect on your own ego to go, well, maybe if I followed my own advice that I'd give to a client, rather than thinking, oh, that's client advice for client, but I know better. That would serve me a lot better. So what I've realized is next time I need to get right out of the way and treat myself as a client, not get involved at all, and just tell the team to treat me like a client, basically.
Yeah. So Nic, tell me, let's do a little scenario here, right? Because a lot of people listening to this, as we all know, we've all heard the stats. 71% of property investors never get past the first property. 90% never get past the second property, right? And so it's easy to assume that the largest cohort of property investors have got one property, but in fact, the largest cohort of property investors have got no properties. So they're sort of just trying to work out how to get started, and nobody knows how many's in that category, but it's got to be millions, right? Millions of people who are desperate to get started, don't know what to do. And then the next biggest cohort of people who got started and made a mistake and now they're stuck. But if you're speaking to someone out there who's got somewhere between 0 and 1 properties, and they're trying to work out, well, how should I think about approaching my portfolio strategy from day one, right? We're talking about buying and selling, and we've talked about all of these kind of things and challenging assumptions. But what advice or guidance would you give to someone who's just in the early stages of their journey? How would they think about this? Is it the right time for them to be thinking about this kind of like buy and sell stuff? Or is it like, what? Just put yourself into mind's eye. Pretend like you're speaking to someone who's just on the start of their journey. What advice would you give them at this stage?
Well, the advice that I wish I'd had back at the start would be buy in trust. And that's I'm just talking about my own journey. What I'd wish I'd done, I should have bought in trust, because that's made me hit a wall, having some properties in my personal name that have kind of limited flexibility and other things. And I think the other thing, I probably wouldn't be considering the whole buy and sell thing at this stage at the start. I'd just be trying to buy good quality property, because that comes later. That comes when your portfolio reaches a certain maturity and you reach a certain, I guess, financial situation, which I talked about earlier, where you're kind of, you've got lazy capital sitting there that you can do better with. But generally speaking, unless the property is going backwards, unless you have good evidence that you're in a market that's peaked and likely to go backwards, my feeling would be to keep money in property, because that's probably where it's going to be best, rather than pulling it out and sitting it in a bank, and use any other source first until you run out of money, and then you go back to your portfolio and start considering which is the laziest capital there. But the biggest one for me would be the trust, and also that shift to growth thinking. So like I said, I was very much yield focused, and I think that was part and parcel with the time. Like there was a golden time 4 years ago, as you know, where every property you bought, you had more income coming in at the end of the settlement, which was amazing. But as times have changed, and as you analyze what's contributing to your wealth in the majority, it's by far and away the capital growth. Like the yield is bugger all. Like it's nice to say I've got a 6 or a 7% yielding property, but if you could sacrifice 2 percentage points of yield and get 2 percentage points of growth, because you're acting on such a bigger sum of money, it makes a huge amount of difference. So if I had my time again, I wouldn't be as yield focused. I'd have a smaller footprint, because I would have eaten away more of my serviceability without going for yield focused assets. But I expect I would have had a better overall wealth position by buying in those higher growth areas. Which, to be fair, at the time when I first was buying with Dashdot, we didn't have that capability to kind of discern between the two. But now it's kind of like chalk and cheese. When you get into a growth market, we're talking like unbelievable amounts of growth.
Yeah, at one point it was kind of like a blended approach. It was like, okay, we can get growth and yield, and we can get this. But now, again, this is another case of like developing better capabilities. Now we can get really deep on this specific market. That's explosive growth. This specific market, really good rent capabilities and yields and all of that kind of stuff. So that's super interesting. Hey, by the way, slight segue, and don't want to overcomplicate this conversation, but have you looked at CGT deferment in trusts?
No, didn't even know the term.
I'm just going to like drop a little seed in this conversation that people, can go and explore. Not financial advice. This is not financial advice. But as I understand it, and I've been doing some explorations around some other assets that I'm looking to move and for a variety of reasons, in a variety of ways. Within a company structure, which is typically a trust with a trustee company and all of this kind of stuff, you potentially have the capability to defer your CGT payment by up to 2 years. And the premise of this is, if, let's say, just pretend you're a company, right? And you've sold some assets and you've liquidated some assets. The premise is that you effectively say, right, give me 2 years to repurpose this capital into another asset, because I'm going to repurpose it. I'm not just going to realize the gain and take it home and go and spend it. So it gets it's like a retained earning within the company, and you sort of like keep it on the balance sheet so that you can find another asset to put it into. And if you do that within 2 years, you don't pay the CGT on it. And so, when you start then thinking about how this relates to a buy and sell type strategy, again, go and get your own advice from a really good accountant on that, right? Go and get your own advice from a really good accountant on that, anyone listening to this. But for a different type of asset, for a different type of purpose, I've had advice that actually specifically is that, hey, you can sell those assets and we can defer the capital gains payment for up to 2 years so that you can reposition that capital into another asset. And if you do that, you won't pay the CGT, which takes a lot of the, like, that's a pretty big component of the kind of like sell side cost, which again is going to help you to magnify your capital, because the 133% gain or return that you got on your initial 122, if you turn that into 285, and let's just say for a second, you just forget about the CGT. If you got another 133% gain on that in another 3 years, you'd be up to $379,000, which would be, wild, 122 to 379 in 6 years if you did that. But imagine if you didn't have to pay the CGT component on it as well. That'd be huge. And so that's definitely something I think people should be thinking about.
Totally, and that's part of the argument for the buy and hold, isn't it? Because you can pull equity without having to pay capital gains. You still have to pay it eventually when you sell the property, but that's part of the argument for buy and hold, is that you don't have to pay CGT if you just keep pulling equity and rolling forward. But at some point, as we know, you hit a wall where you can't just keep pulling equity because you're limited by your own serviceability. And at that point, that's where I've come to that realization that it's worth selling, paying the tax and moving on. But if there's a way to defer that and have that money that you would otherwise have paid tax earning for you, even if it's for 2 years or longer, then that's a huge win. It's another leverage piece, really.
Yeah, totally. So it's definitely worth looking into. Nic, as always, I've enjoyed our conversation. It's always interesting, fun, insightful. I hope that you've enjoyed it as well.
Been great. Loved hanging out with you, Keith.
Awesome. And guys, if you're listening to this and you've enjoyed it, if you've found something in this that you think is valuable, interesting, or maybe you think is absolute garbage, take the opportunity to share this with somebody else and tell them how you feel, because that's going to help more people get access to these ideas. It's going to help more people to build wealth, become more successful, and live a life of freedom, choice, and abundance, which is the absolute goal. And of course, if you want help to accelerate your property journey, then to be on the winning side of property, then head to dashdot.com.au/discovery, book in a call, have a chat with the team, see where you're at, see where your constraints are, and see how you can get started today as well. Nic, great to see you. I'll see you again soon.
See you soon, mate.